Good afternoon, everybody, and welcome to this webinar on the new IFRS 16 leases. Very exciting because brand new standard issued on the 13th of January this year, and during the past week, the Australian Accounting Standards Board also approved the equivalent AASB 16. AASB 16, however, is not available on the AASB's website yet, but at the board meeting this week it was approved. Having worked at the AASB, and Dean would agree with me, we know that it will now take a number of weeks for them to get all the little details in place to publish it on the website. But the new IFRS 16 has also now become the new AASB 16, so very exciting. In today's webinar, just before we go on, I just want to talk about the disclaimer a bit. Just to remind you that when I talk about IFRS 16, I'm talking about the standard from an Australian perspective. So if you're watching from another part of the world, you might have different perspectives on the standard. So it's an Australian perspective. And IFRS 16 is not the same as the Leases standard in America. So just up front, make sure that you're aware of that. So if we look at the roadmap for the session, first of all, I want to start with the big change for lessees. So usually I start with an overview and a slow introduction. I thought with leases, let's go for the big news, and that is the big change for lessees. Then we'll look at the reasons for issuing IFRS 16. We'll then look in section 3 at determining when to apply IFRS 16. Because again, that's a new development. Currently we have IAS 17 or AASB 117. We've got interpretation 4. We've got interpretation 115 around lease incentives. So all of that has been replaced by the new IFRS 16. So we have to decide, so when do we apply IFRS 16? So what's within the scope, what's outside the scope? Very important. Then in section 4, we look at the accounting treatment in the records of the lessees. And as you will see right at the start, there's a big change for lessees. In 5, we look at the accounting treatment in the record of lessors. And there's minimal change in the records of lessors. And then lastly, I've got it all back to front today. I look at an overview of the new IFRS 16. So we start with the big news and we work our way down to a bit of an overview or a recap of IFRS 16. So let's start with our normal quiz question. In the question box on the right-hand side, please let me know which author wrote the novel The Choice on which the 2016 movie was based on. Any ideas? And let me know if you've seen the movie. I haven't seen it. So if you use the question box, let me see, what do you guys say? Apparently it's a chick flick, according to one of our participants, and therefore they don't know, or they don't want to acknowledge publicly that they know about a chick flick. Any other ideas? Oh, beautiful. I even have, it's not a chick flick because some of the males also have the answer. So well done. Thank you for participating. So we look at, it's Nicholas Sparks. I didn't know. I haven't heard of the movie, but if it's a chick flick, definitely it's one for me to go and see. So if we look at the big change for lessees, and this is the big news that we're starting with today. First of all, the change is that this really is, for all practical purposes, the end of the road for operating leases as we account for it currently in the records of lessees. So it's a big change. Why is that? Because the new IFRS IFRS 16 introduces a single lessee accounting model, which means that all leases will be accounted for in a similar way, and that way is the way in which we currently account for finance leases. So operating leases currently, we have an even or systematic expense over the lease term, and we don't have assets and liabilities on the balance sheet. Going forward, all leases, so the current finance leases, the current operating leases, all of them will be treated exactly the same way, and that is we'll have an asset and a liability in the balance sheet, and we'll depreciate that asset over the period of the lease, and we'll have an amortization table that will determine as we repay or as we make the lease installment, which part is a repayment of the loan and which part is interest on that loan. So whatever we currently do for finance leases, going forward, we'll do that for all leases. There are two exceptions, but in general, those are the rules. So it's a big change. I thought the best way to illustrate it is to look at an example, and at the end of this example, I would like to compare the current accounting treatment in terms of AASB 117 with the new accounting treatment in terms of IFRS 16, and specifically the impact on the statement of comprehensive income, the impact on the statement of financial position, and the impact on the statement of cash flows. So in this example, I thought I'll keep it simple. Entity A entered into a 3-year lease of an administration building with the following lease payments. So it's payable at the beginning of each month. So we've got $5,000 per month for the first 12 months, then $6,000 per month for the next 12 months, and $7,000 per month for the last 12 months. So a lease for 3 years. Additional information that entity A, who is leasing this building, has an incremental borrowing rate of 10% per annum. So that's the background information. So let's start with accounting treatment for the lessee in terms of the current AASB 117. So the current AASB 117 would require you to make an assessment whether this lease is an operating lease or a finance lease, and there are a lot of guidance on making that judgment call. Now in this one, it's clear that it's an operating lease. We're using a building only for 3 years, not for a majority of its expected useful life. The lease payments is not the present value of the lease payments is nothing close to the market value or fair value of the building, etc. We can summarize it to say it's an operating lease because the lease does not transfer substantially all the risk and rewards incidental to ownership of that building to the lessee. The lessee is merely using the building for a period of 3 years, and we know that building would have an expected useful life of many more years. So it's an operating lease. Therefore, with an operating lease, we determine an even operating lease expense over the 3 years of the operating lease. We could use a different method if a different method would give rise to a systematic allocation. But in this instance, it's a time period that you'll be using the building. So we work out that an even operating lease expense would work out to be $72,000 per year. So that's the even expense. So in year 1, we're paying a little bit less. In year 3, we're paying a little bit more, but an even expense. So what we expect to see in the profit and loss or in the statement of comprehensive income is an operating lease expense of $72,000. We do not expect to see an asset in the statement of financial position. We do not expect to see a liability in the statement of financial position. Obviously, we'll have a cash flow, and the cash flow would be the actual cash flow amount, so 60,000 in year 1 and 72 in year 2 and 84 in year 3. I think what's important, how would users know about this operating lease that's in place? The only way they'll know is there will be a note in the financial statements, usually one of the last notes where we disclose commitments. So in that commitments note, we will say, listen, we've entered into an operating lease and we'll be making these payments over the remainder of the lease. So it's not in the balance sheet clear that we've got this commitment, it's in a note to the financial statements. So if we look at the journal entries, in year one, as we pay the $60,000 cash, we'll say credit bank and debit our operating lease expense. And because we know the operating lease expense should be $72,000 per year for the 3 years, it's an even expense, we debit our operating lease expense with an additional $12,000 to get to that 72, and the credit is an accrual or a liability. So the only liability we'll see is a small liability, and it doesn't relate to all future operating lease payments or installments. It is just to fix the differential between the expense and the cash flow that occurred in the current year. In year two, the cash flow equals what we want the operating lease expense to be, so no further journal entry, that's just the one journal. And then in year three, we have our normal cash flow, credit bank the 84, debit our operating lease expense 84. However, we know the expense should only be 72, the even expense. Therefore, we credit the operating lease expense with 12,000 to get back to the 72. And we now debit that accrual or that liability that we created at the end of year one. So at the end of the lease term, we no longer have a liability. So that's the accounting treatment currently, AASB 117 for operating leases. If you look at the accounting treatment in terms of the new IFRS 16, in the new IFRS 16, we say as soon as you've decided it's a lease, and we'll talk about that decision a little bit later, but once you've got a lease, with the exception of two practical expedients, normally, all leases would be accounted for in exactly the same way. And for all leases, you'll have to account for them as assets and liabilities on day one, and your lease installments is the repayment of that loan. So in substance, we've got a right of use assets which we capitalize. We've got a liability already on day one. As we repay the liability, we have to use an amortization table to come up how that cash flow is split between a principal repayment and an interest expense. So here you can see I've done this amortization table using the entity's incremental borrowing rate of 10%. The cash installments or the lease payments, I've got the cash flows in the second column of 60, 72, 84. Using the incremental borrowing rate of 10%, I've done this amortization table. So these numbers we now use to do the journals. How do we do that? On day one, when we enter into the lease, we will now say debit a right of use asset and credit a lease liability, the 185,426. So on day one, when we enter into the operating lease of this building for 3 years, we acknowledge that we've got an asset and it's a right of use asset. We've got the right to use this asset for the next 3 years. So we debit a right of use asset and we credit a lease liability with the net present value of the future lease installments. And we get that, or we use our financial calculator or Excel to determine that. So that's day one. Our journal entries for year one, at the end of year one, we would say we know the cash flow in year one was $60,000, so we credit bank $60,000. According to our amortization table, our interest expense is nearly $15,000. Our lease liability, the capital repayment, is around $45,000. And then the other thing is we've got this right of use asset. At the end of year one, our right of use asset, we only have right of use for another 2 years. So we have to amortize that right of use asset. We amortize it over 3 years, the lease term. So we have debit amortization expense and credit accumulated amortization. In year two, same journals. We have a a cash flow where we repay the liability of $72,000. We split it between interest and principal, amortization expense again, and the same in year 3. And we use the numbers from that amortization table. So this is what we currently do for finance leases. So most accountants would be happy with this. If I say happy, would understand how to do the journal entries, would understand how to do an amortization table, because we currently do this for finance leases. The new thing is we now have to do it for all leases, or practically all leases. So if we just look at this example, and this is really what I want to illustrate in this example, how the two standards, the old and the new, have an impact on the statement of comprehensive income, because it's only when you put the numbers next to each other that you can see the impact. Now, the current AASB 117 will have an even operating expense of $72,000 over the 3 years. So the total expense over the 3 years, $72,000. However, when you look at the new IFRS 16, there'll be an interest expense, and I have to apologize, I now see a mistake in my own column. The year 3 numbers are wrong. If you look at the interest expense, in year 1, you've got your interest expense according to the amortization table, more or less. What have I done here? I reckon I've been... Yeah, I can see. Sorry, year 3 is wrong. I just want to go back to look at the amortization table. Here in the amortization table, the interest expense in year 3, you can see is 4378. So if we go back to where we were just, in year 3, I'll just show you that 11,300 in year 3 should be the 4378. So what you can see here is your interest expense in year 1 is around 15,000. Your interest expense in year 2 is 11,300, and your interest expense in year 3 is, $4,000 or $5,000. So you can see that your interest expense, there's a big expense in year 1, and that expense is decreasing because we are repaying the loan, and as the loan or the capital outstanding decreases, your interest expense will decrease. Your amortization expense, or the amortization of your right of use asset, is evenly over the 3 years. The impact of this is that over the 3 years, you can see that your total expense is actually going down. The biggest expense is the end of year 1, and the lowest expense is in year 3. So at the moment, operating leases has an even expense. Going forward, that won't be the case. There would be a big expense in year 1, potentially, and going down in year 3. If we look at the statement of financial position, and I really hope I got this one right, it looks better. If you look at the statement of financial position, your right of use asset at the end of year 1 will be the right of use asset that we had on day 1 after it's been amortized for 1 year. In year 2, obviously, we've amortized for another year, and in year 3, it would be fully amortized. Your lease liability would be the balance outstanding, the capital balance outstanding on your liability. At the end of year 1, we've got 140,000. The end of year 2, the 79, and the end of year 3, it's all repaid. If you look at the total numbers, you can see the impact that it's got on your net assets or liability in your statement of financial position. It doesn't necessarily even out in year 1 and year 2. It should even out at the end of the lease term. But it really leads to a decrease in your net assets, in my example, in years 1 and 2. So if you think about something like bank covenants, you should consider the impact that the new leases standard will have on your net assets and liabilities. You should also consider in our previous slide the impact that new leases standard will have on your statement of comprehensive income and specifically profit or loss. Because, year 1 you've got a big expense and the last year a smaller expense. And, how would that link to your KPIs and bonuses, etc.? The last one is the cash flow. Now the cash flow, the total cash flow doesn't change for any of the years. However, the way we disclose the cash flows in the statement of cash flow, or the statement of cash flows, or cash flow statement, would be different, because you're at the moment, in terms of AASB 117, your operating lease expense would be an operating cash flow, which is the 607284. Now going forward, the interest part would usually be an operating cash flow. So there's a big reduction in your operating cash flows. And then you'll also have this financing cash flow, or in fact a financing cash outflow, because you are repaying a liability, the 45, 60 and 79. Now I know some people disclose the interest expense also as a financing a cash flow. It depends on what your policy is. So there is an actual potential to have currently an operating cash flow in year one of an outflow of 60,000, and with the new IFRS 16, it's got no impact on operating cash flows, but it actually has a financing cash outflow of 60,000 if that's what you want to do. Personally, I've always liked to split the interest to go to operating cash flows, and the repayment of the capital to go in the financing cash flows. So overall, it doesn't have an impact on cash flow, but it does have an impact on the presentation in your cash flow statement. So I think what I wanted to illustrate in this example is, yes, we know that all operating leases will now be accounted for as finance leases, and a lot of people have just said, oh, that's all right, we'll bring on an asset and liability, it will be more or less the same. That's not necessarily the case. It could lead to an increase or decrease in your net assets, as I've illustrated. Yes, your cash flow is the same, but it would be disclosed in different parts of the cash flow statement. And the big thing for me really is the impact on profit or loss, and the fact that you could potentially have this uplift in your expense in year one and a lower expense in year three. So these are all things to think about, especially your business and what your banking covenants are, and consider how this change would impact your covenants. What would your impact on your KPIs be? What would your impact be on your deferred tax assets and liabilities? So important to have a look at that. So what are the reasons for issuing IFRS 16? So we've gone through this big change. Why? A lot of people ask why. Personally, AASB 117, I've always thought, it's such an easy standard. It's easy to understand. It's simple. It's well understood by everybody. So why the change? The reasons for the new IFRS 16 is the International Board and the AASB have made it very clear that it provides greater transparency of the lessee's financial leverage and the capital that they've employed. So financial leverage, they want us to disclose in the balance sheet, in the statement of financial position, our lease commitments, not just in a note, but in the balance sheet. And capital employed, they want us to disclose all the assets that we've used in our business to generate profits. So they believe that if we bring all these operating leases on the balance sheet, it would provide a complete and an understandable picture of the entity's leasing activities. A number of users of financial statements have actually indicated that they look at the commitments note and they adjust financial statements accordingly to make their analysis. So users were a big driving force in this change. And there's always been these concerns around off-balance sheet financing. The fact that entities can enter into operating leases and keep that liability out of the balance sheet, hidden in a note, where other entities enter into a finance lease and the asset is on the balance sheet but also the liability. And then the comparability between those two entities has always been a big issue. So it's really a big part of what's driving this decision, to get a complete picture of all liabilities, but also all assets employed by the business. So that's the reason for the change. I know Sir David Tweedy, who used to be the chairman of the International Accounting Standards Board, he always used to use the example that he is looking forward to the day that he is actually flying on a plane that's in the books of the airline. Because a lot of the airlines lease, through operating leases, their aircraft, they were obviously not in the balance sheet. And so that was his standard introduction when he talked about leasing. I think one of the big problems around the current leasing scenario is that it's so judgmental, the decision between whether you've got a finance lease or an operating lease. And there was concern that's being manipulated. Later on, when we talk about the decision on whether you've got a lease or not, you'll see there's still a lot of judgment. It's now just judgment at a different place. It's really hard to get rid of judgment in accounting standards. We have to think, apply our judgment based on our knowledge, experience. Another quiz question. In 2015, William C. Campbell was awarded the Nobel Prize for which category? Anybody know this one? Please help. Anybody know this one? Any ideas? I think, there's quite a few people that know. Now, I had to look it up on Google this morning. I have to say that the technical team has a new team assistant who's Annalie, because Bree is on maternity leave. And I said, please, Annalie, help with the quiz questions. Otherwise, it will just be sport questions if I do it. And she came up with some beauties today. So, yes, a number of you are right on this one. It is, you got the prize for medicine, which is extremely impressive, I might add. So if we go on to section 3, determine when to apply IFRS 16. So after we've talked about the big news and we talked about the reason for the new IFRS 16, I want to move on to when to apply IFRS 16. Now this is now where we have the judgment call. So in the current AASB 117, the judgment is around, do you have a finance lease or an operating lease? Now the judgment has moved to, when do we have to apply IFRS 16? So step 1 in that process is to identify a lease. And around identifying a lease, they say at inception of a contract, an entity shall assess whether the contract is or it contains a lease. So as soon as you've got a contract, you have to think, is this contract a lease or does this contract contain a lease? And go further to say a contract is an agreement between 2 or more parties that creates enforceable rights and obligations, which is the same definition we have in AASB 10, AASB 11, AASB 15 revenue. So at the inception of any contract, we have to consider, do we have a lease in here or not, or is this whole contract a lease or not? So very important. Now this decision tree comes from IFRS 16 in the appendix. There's this beautiful table to put it all together. So I'm going to talk through the table and then I've got some slides explaining certain parts of the table. So the very first question, if we want to consider whether IFRS 16 should be applied or not, is we have to ask, is there an identified asset? Because if you say no, there's no identified asset, then the contract does not contain a lease. So it's critical to know, do we have an identified asset, yes or no? That means that there's a clear distinction now between the use of an asset, which if it's an identified asset would be a lease, and a service contract. And service contracts are outside the scope of IFRS 16 and they don't come onto the balance sheet. If it's an identified asset and we answer appropriately on all the other questions, we could potentially have a lease. So there's a very clear distinction between asset contracts or contracts to use an asset and service contracts. So that's an important note. So is there an identified asset in this contract? If you answer no, there's no lease. If you answer yes, we consider another question. The next question is, does the customer have the right to obtain substantially all of the economic benefits from use of the asset throughout the period of use? So if you look at and they talk about customer, they don't talk about lessee because we haven't decided yet whether it's a lease or not. So the customer, do they have a right to obtain substantially all of the economic benefits from the use of this asset throughout the period of the use? So is the customer going to obtain the benefits from this asset for the period that they're using this asset? If you say no, then it's not a lease. If you say yes, you live to answer another question. Next question, third block. Does the customer, the supplier, or neither party have the right to direct how and for what purpose the asset is used throughout the period of use? So if the customer have the right to direct how and for what purpose the asset is used throughout the period of the lease or the period of use, if the customer makes that decision, then we've got a lease. So the customer, there's a specific asset, the customer is getting substantially all the economic benefits and they can decide how they use the asset. Happy? Then we've got a lease. If the supplier can determine how and for what purpose the asset is used, then it's not a lease because the supplier is still in control. If it's neither, you have to go to another question. So if you're not sure whether it's the supplier or the customer, you should ask the question, does the customer have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? So if I can use the asset based on certain predetermined operating instructions and the supplier can't change it, if I answer yes to that, it's a lease. If I say no, there's yet another question. Did the customer design the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use? If you say no, it's still all about the supplier. It's not a lease. If it's driven by the customer, we've got a lease. So a number of questions to answer to determine who has control of the asset for the period of the lease. Is it the customer? Then we've got a lease. Or is it the supplier? Then it's not a lease. And there's some, variations. So if it's the supplier that has the control, it's not a lease and the customer will not put it on its balance sheet. If the customer, in substance, have control of this asset for this period of time, we say it's a lease, which means it will come on balance sheet. All right, so again, a judgment call on various levels that impact whether this asset will be on or off balance sheet for the customer. So if we look at identified asset, as I said, there's a lot written in the standard and in the appendix to the standard on answering each of these questions. Now, I don't have the time to look at each of the questions. I'm just trying to give an overview today. I've just selected certain areas to talk about. And the one is identified asset. So the identified asset, it should be explicitly, one alternative, it's explicitly specified in the contract. Or it could be implicitly specified at the time that the asset is made available for use by the customer. Even if an asset is specified, a customer does not have the right to use an identified asset if the supplier has the substantive right to substitute the asset throughout the period of use. So even though the asset is specified, you have to look a bit further. If the supplier has the substantive right, and we'll look at what a substantive right means, to substitute the asset throughout the use, then it's not an identified asset, and therefore it's not a lease or doesn't contain a lease. And then they go further to say a supplier's right to substitute an asset is substantive only if both of the following conditions exist. So the supplier has the practical ability to substitute alternative assets throughout the period of use. So it's a practical ability, not just written into the contract. We can practically do it. Or the supplier would benefit and the supplier would benefit economically from the exercise of its right to substitute the asset. So both things have to be in place. A practical ability and an economic benefit for the supplier. And if those things are in place, we cannot have a lease. The other question, or the second question, was around rights to obtain economic benefits from use. And now this could be directly or indirectly. So it could be using an asset or holding the asset or subleasing the asset. So economic benefits from use is a very wide definition. Another example would be if you've got the exclusive use of an asset throughout the period, then you get the economic benefits. Only you use it, only you get the benefits. And then they give us some examples of what economic benefits from use could be. It could be the primary output. So if you're leasing a machine and you're manufacturing goods, that's a primary output. It could be byproducts. It could be including potential cash flows derived from these items. So byproducts, you're manufacturing one item, there's also some scrap metal at the end, and you sell those scrap metal for cash. Now that's also an economic benefit. Or any other economic benefits from using the asset that could be realized from a commercial transaction with a third party. So economic benefits are a real wide definition of economic benefits. So step one we've looked at. Let's move on to step two. You now have to decide whether you want to apply any of the practical expedients. Now, last month when we talked about AASB 15 in our webinar, I introduced the term practical expedients into our accounting vocabulary. AASB 15 is the first time I've heard about practical expedients. So in IFRS 16 we see it again, and it looks like they'll be with us in other standards as well. So you can now choose whether you want to apply the practical expedients or not. You can ignore these practical expedients. It's accounting policy choice. So what are they? So a lessee may, so you don't have to, you may elect to not apply the lease accounting model to short-term leases and to leases for which the underlying asset is of low value. So if you've got a short-term lease, you're going to say, I don't want to do this accounting treatment in IFRS 16. I want to continue with what I currently do for operating leases in terms of AASB 117. So that's systematic even expense, more or less. Or if you've got leases for which the underlying asset is a low value, you don't have to capitalize and have an asset and a liability and do amortization tables. A lot of work, cost benefit, not worth it. You could say low value, I'm going to do what I currently do for operating leases again. So those are the two things that you have to think about. The first one, so what does a short-term lease mean? Now, a lease that at the commencement date has a lease term of 12 months or less is a short-term lease. And as soon as a lease contains a purchase option, it is not a short-term lease. And you can make this election by class of underlying asset. So it's not on an asset by asset basis, but you do it for a class of assets. So short-term leases, 12 months or less, you don't have to capitalize and do the amortization table and the whole thing. So be careful if you've got a lease that is 12 months or less, but you also have this purchase option included in it, you can't use this practical expedient. So you have to meet the definition of a short-term lease. What about the underlying asset is of low value? That's a second practical expedient. So what does low value mean? So there's a lot of discussion around it. They haven't given us a number. They haven't said low value is below X dollars. All right, so they've given us guidance to make a decision. So again, a lot of judgment. So this is what they say about it. So the value of your underlying asset is based on the value of the asset when it is new, regardless of the age of the asset that's being leased. So even if I'm leasing an asset that's 10 years old, if I want to decide whether that asset is of low value, I have to consider what would I pay for this asset when it's new. All right, so it's based on new values, not second-hand values. The next thing is the assessment on whether this underlying asset is of low value is performed on an absolute basis. So an absolute basis, it's not a relative basis. Leases of low value assets qualify for the accounting treatment in paragraph 6, regardless of whether those leases are material to the lessee. So materiality has nothing to do with this assessment on whether it's low value or not. So you look at big entities, materiality could be very high. That doesn't mean everything below their materiality level is subject to this practical expedient. So it's an absolute basis. It's not relative. Materiality is a relative. The assessment is not affected by the size, the nature, or the circumstances of the lessee. So they're saying it again. I don't care how big you are, what the nature of your business is. So what they're really saying, and that's the last bullet point, they would expect different lessees, so whether the lessee is small or big, for-profit, not-for-profit, private sector, public sector, listed, non-listed, they would expect different lessees are expected to reach the same conclusions about whether a particular underlying asset is of low value. All right? So it's on an absolute basis. It doesn't have anything to do with materiality. It doesn't have anything to do with size, nature, or circumstances. It's not a second-hand value. It's a new value. And they say an underlying asset can only be low value if the lessee can benefit from the use of that asset on its own or together with other resources that are readily available to the lessee, and the underlying asset is not highly dependent on or highly interrelated with other assets. So it has to be a clearly a separate asset, not interrelated with other assets. So you cannot take an asset and break it into parts and say this part is low value and the rest is high value. So, it can only be low value if you can benefit from it on its own and it's not dependent on other assets. And then the other thing is they say a lease of an underlying asset does not qualify as a lease of a low value asset if the nature of the asset is such that when new, that asset is typically not of a low value. And then the example they give here is the lease of a car. Leases of cars would not qualify as leases of low value assets because a new car would typically not be of low value. All right, so we don't care whether we buy the smallest car or the most expensive car, whether our entity is small or big. That's some guidance that cars definitely is not low value. They also say if a lessee subleases an asset or expects to sublease an asset, the head lease or the original lease does not qualify as a lease of a low value asset. So they're saying, low value assets cannot be sublet. As soon as you want to sublease or can sublease, it's not a low value asset. And then they give us some examples of low value assets. And they say it's like a tablet on iPad or personal computers. That could be low value. Small items of office furniture, telephones, mobile phones, that could be low value. So they expect all tablets, personal computers, telephones, mobile phones, those kind of things are low value. You don't have to capitalize and bring it on the balance sheet. So that's the second practical expedient. And then the third step is to separate your lease and non-lease components in your contract. So you account for each lease component within the contract as a separate lease, and you account for it separately from non-lease components. Unless, again, the entity applies a practical expedient. So the entity has a choice. The lessee may elect, and this time by class of underlying asset, not to separate non-lease components from lease components, but instead to keep the whole thing together and to disclose it as a single lease. So the standard says you have to separate a contract into lease components and non-lease components and account for them separately, but you could, and you've got this decision by class of underlying asset to keep it together as a single lease component. So really important, if we look back at this discussion, that IFRS 16 introduces a clear dividing line between leases and service contracts. And leases will be brought on the balance sheet. So this is leases of assets, identified assets, will be brought on balance sheet. And service contracts will remain off balance sheet. And you can see what we've discussed here in section 3 is there will be a lot of judgment to determine whether indeed it's a lease or contains a lease, whether we apply the practical expedients around short-term lease or low-value assets, and whether we want to keep the contract as one or separate it into its components. So this is where the judgment is now. It's no longer just between finance lease and operating lease. Another quiz question. So the martial art called, I can't pronounce it, Aikido originated in which country? Any ideas? At least I could guess this one, right? Yes, most of you have it right already. I can see it. Good guess. Really good. Really good. Well done. That was my guess as well. I thought martial arts, it can only be one place. It has to be Japan. I haven't heard of this specific martial art before. So I reckon I should look for a YouTube video to see what it looks like and how it works. Section 4. And this is now the accounting treatment in the records of lessees. Now, we've talked about this a lot already today because this is how we currently account for finance leases, but I thought I'll recap for completeness purposes. So for recognition purposes, they say at commencement date of this lease, if you've decided it is indeed a lease or contains a lease, a lessee shall recognize a right of use asset, a right of use asset which is an intangible asset. I've got the right to use the asset, it's an intangible asset, and a lease liability. If you look at the initial measurement of that right of use asset, at the commencement date, a lessee shall measure the right of use asset at cost. And then they go further. So cost of this right of use asset shall comprise the following. So earlier, I saw there was a question on how did I come up with my 185 in my amortization table. We'll work through that now, and that's why I've not responded to that question earlier. So the cost of the right of use asset comprises of the following. The amount of the initial measurement of the lease liability, which we'll discuss very soon. Any lease payments made at or before commencement date, less any lease incentives received. Any initial direct cost incurred by the lessee, and an estimate of cost to be incurred by the lessee in dismantling and removing the underlying asset or restoring the site on which it is located, or restoring the underlying asset to the condition that required by the terms and conditions of the lease. unless those costs are incurred to produce inventories. So this last bullet point is very similar to the requirement we have around AASB 116 property, plant and equipment, that on day one you can already account for or include in the cost of property, plant and equipment this potential dismantling cost, and you create your liability in terms of AASB 137. So it's a similar requirement included in the cost of your right of use asset. So the initial measurement of the lease liability, which is important because it feeds into the first line here. The initial measurement of the lease liability at the commencement date, a lessee shall measure the lease liability at the present value of the lease payments that are not paid at that date. So in my example earlier today, you come up with the present value, you use that 10% incremental borrowing rate that I've given in my example, and you come up with the present value of all those lease installments. And you have to remember that they are paid monthly in advance. You've put all of those cash flows into Excel or in your financial calculator. You use the interest rate of 10%. The present value works out to be the 185,000. The lease payments shall be discounted using the interest rate implicit in the lease, if that rate can be readily determined. So if you can determine the rate that they've used to come up with your payments, if it's in your contract, etc., that's your first preference. In my example, I've said it's not readily determined, and therefore I've said you'll use the lessee's incremental borrowing rate, which in my example I said it was 10%. So that's the order in which you do it. If you look at subsequent measurement of your right of use asset, there's different models. You could have used the cost model. You could have investment property at fair value in terms of AASB 140, or you could have the revaluation model in terms of AASB 116. So there's 3 different models available. Whichever model you use, remember that also impacts, whether you amortize or depreciate that right of use asset going forward. And there's specific guidance of each one of these 3 in the new IFRS 16. If you look at subsequent measurement of the liability, you measure the liability by increasing the carrying amount to reflect the interest on the lease liability. You reduce the carrying amount to reflect payments, cash flows, and then you also remeasure the carrying amount to reflect any reassessment or lease modifications, or to reflect revised in substance fixed lease payments. I think what is important to remember here, that this lease liability, although it is a financial liability, it's not within the scope of the new AASB 9 financial instruments. It's specifically within the scope of the new IFRS 16, and therefore you measure it in terms of the rules in IFRS 16. Presentation, a lot of people ask, where do I go with this intangible asset, this right of use asset? So a lessee shall either present in the statement of financial position, or you disclose it in the notes, so you can decide where. You disclose a right of use asset separate from other assets. If you don't present this right of use asset separately in the statement of financial position, you will include the right of use asset within the same line item as that within which the corresponding underlying asset would be presented if they were owned. So although a right of use asset is an intangible asset, if you are leasing or you have the right to use property, you will include this right of use asset within property. So you look at the underlying asset and you classify the right of use asset with other assets similar to the underlying asset. This right of use asset is not together with intangible assets unless the underlying asset is an intangible asset. And the lease liability, again, you disclose separate from other liabilities. And if you do not present it separate in the statement of financial position, you will disclose where did you include it? Where did you put it within? Which line item did you put it within the statement of financial position? So if you've included it with another specific borrowing or liabilities, you have to, clearly disclose where it's included in. Disclosure, a lot of disclosure requirements. You have a depreciation charge for the right of use asset by class of underlying asset, depreciation or amortization charge. You have an interest expense on your lease liabilities. You have to disclose the expense relating to short-term leases, which you've accounted for by applying the practical expedient. The expense relating to leases of low value assets, again, because you've used the practical expedient, you have to disclose what is the expense related to those low value assets. If you look at disclosure, you have to disclose the expense relating to variable lease payments not included in the measurement of lease liabilities. And you have to disclose separately income from subleasing right of use assets. You have to disclose total cash outflow of leases. You have to disclose additions to right of use assets. You have to disclose gains or losses arising from sale and leaseback transactions. And I have to flag this. I haven't discussed it today, but there's new requirements around sale and leaseback transactions and how you account for that. So that's a new area. And then the carrying amount of right of use assets at the end of the reporting period have to be disclosed by class of underlying asset. So these are the key new disclosures. There's a few others, but I try to just focus on the key ones. If we move on to section 5, which looking at accounting treatment in the records of lessors, it is basically a status quo of what we currently have in AASB 117. So this is where it gets really messy, because if you're a lessee, you have all these new rules, and for a lessor, they still distinguish between a finance lease and an operating lease, and they still have to make that judgment call, and they still have the accounting that we've had in the past for those two different types of leases. There are some enhanced disclosures for lessors to provide better information. There are a few differences. The changes would be that lessors are also subject to the new definition of a lease. Lessors are also subject to the new sale and leaseback guidance. Lessors are subject to the new sublease guidance, new disclosure requirements, and there's also some specific new guidance around modifications to leases by lessors. So there are some differences, but not big, huge differences. So just be aware of that as well. So at the end of the session, nearly done. If we look at an overview of the new IFRS 16 key changes, it's a single lease model. All lessees account for leases in the same way. From a lessee perspective, there's no distinction between operating and finance leases. They recognize assets and liabilities for all leases with limited exceptions, the two practical expedients basically. And all leases will be accounted for the same way we currently account for finance leases. And there's no substantial changes to lessor accounting. So these are the key changes. Come on. Why can I not move it on to the next slide? That's interesting. Page down. It looks like my computer has just frozen. Let me try again. The rest of the overview, the standard was issued in January this year. It's effective for annual periods beginning on or after 1 January 2019. It's a few years away, but we have to carefully consider whether we have all the data to do what the new standard requires. Do we have the systems in place? Do we, do a number of calculations to determine whether we want to use the practical expedients or not? How will it impact bank covenants? How will it impact KPIs, bonuses, etc.? You can early adopt the standard if you are also early adopting IFRS 15 or AASB 15. So that is a possibility. IFRS 16 supersedes in Australia AASB 117, Interpretation 4. And you know, Interpretation 4, which has a lot of guidance around determining whether an arrangement contains a lease, that Interpretation 4 is now embedded in IFRS 16 and it's changed. So we could potentially reach a different conclusion when we apply IFRS 16 as the conclusion we reached under IFRIC 4. Then Interpretation 115 or IFRIC or the related IFRIC, which is SIC 15, is included in IFRS 16, and also Interpretation 1 to 7. So all four of those documents now embedded into IFRS 16. So last quiz question for today, and this is as close as we are getting to a sport question for today. Who sang the national anthem at the Super Bowl 50? At Super Bowl 50. Any ideas? Who sang the national anthem? By some luck, I knew this one. Yes, a number of people know this one. Well done, well done. So this one, Lady Gaga sang the national anthem. Roundup of the session, we looked at the big change for lessees, the reasons for IFRS 16. The big judgment call is now around determining when to apply IFRS 16. How do lessees account for leases? How do lessors account for leases? And a bit of an overview at the end. If you want to watch more of these webinars, and the easiest way is to link with me or Pitcher Partners on LinkedIn, and I'll put all the information there as we go along. If you would like to receive our monthly newsletter, again, please contact me, and we could arrange that. Also, if you or any of your colleagues have missed this webinar, it will be available on YouTube. For our Pitcher Partner staff, please don't watch it through YouTube, because we would like you to watch it through My Development or the link to the recording, because then we can monitor your attendance. The newsletters are also available on our Pitcher Partners website if you're looking for it. Any questions, please send that through. I'll just respond to earlier questions. A number of people have asked me, Aletta, is this new IFRS 16 included in our CPA studies this year or our CA program studies? And I have to say, I have no idea. You'll have to contact chartered accountants and CPA about that and ask them whether it's included or not. When they decide to include it in their modules, don't know. So that's something definitely that you'll have to do. So I think really important in Australia, there's another question around that, the effective date. In Australia, it would be for 30 June 2020 year ends, if you've got a 30 June year end. If you've got a 31 December year end, it will be 31 December 2019. Right, so the effective date, I think, in Australia would be similar to the international one, as far as I know, but I haven't seen the final AASB 16. So thank you very much for attending this webinar. The recording will be sent out to our staff and will also be placed on YouTube and on LinkedIn. I hope you join me next month, and next month we're looking at the new AASB 9 on financial instruments. And just a reminder that I haven't looked at the whole of IFRS 16 today. There's many more parts to it. It was a quick overview. We'll look at it again going forward. And then I've looked at it from an Australian perspective. And it's very different to this in the US especially. Thank you very much for joining me.